Hi there, Adrian here, mortgage broker based in Sydney. On this channel we talk about all things lending, investments and finance. And I'm sure if you clicked on this video, you're asking yourself the question, which way are interest rates going to go and how high are they going to go? Now, we definitely don't have a crystal ball, but you can see what's happening in the markets. So if you haven't been watching what interest rates have been doing, here's a quick rundown. So over 6 months ago, maybe 9 months ago, we had all the 4 and 5 year fixed rates go up through the roof. All right, so they used to be, if you remember, St. George about 12 months ago was putting these great 4-year interest rates on the market for owner-occupied under 2%. Now, if you go and try and source a 4 or 5 year fixed loan, you're looking at anywhere over 3.5% to 4% minimum. All right, then what happened was there was a little bit of a break of 3 to 6 months, and then we get to kind of our last 3 to 4 months. So what we've been seeing is all of the variable rates have been going down and all of the fixed rates have been going up. All right, so the 2 and 3 year fixes, to give you some, some idea on one particular product, we had owner-occupied rates which were around 1.79 to 1.99 on a 2-year fix under 80%, have now gone upwards of 2.7 in the mid-tier banks to 3.2 in the big six banks. So you're looking at 0.8 minimum rise, and some of the banks have gone up at as of 1.2%. So we've been seeing what's been happening. The general trend has been 5 to 6 rate increases, and the main 2 banks that have been leading the charge has been Commonwealth Bank and Westpac. So normally what happens is those 2 increase their rates, and then the mid-tier banks follow them slowly over the next couple of weeks. That's what we've been noticing. Now, on the variable rates, it's actually changed quite a lot in the last 12 months. They used to be around that kind of 2.7% mark over 12 months ago on owner-occupied principal and interest under 80%, and now they've actually come down the same amount that the fixed rates have gone up. So we've been looking at anywhere from between about a 1.99 to a 2.19 with the majority of the banks on owner-occupied principal and interest on variable. So a lot of people, what they're seeing is they're seeing a huge gap between the variable rates and the fixed rates. So if I want to use my client book as an example, because I'm a mortgage broker, as soon as the rates started going over 2.8, a lot of the clients started focusing on the variable rates, because this is how they're kind of quantifying their decision. And bear in mind, this is only general advice and talking about the market. It is not tailored advice to you. And at the end of the day, I can never really tell you where interest rates are going to go and how much, and also tell you what to do regarding rates. I can only really talk about products, hand that information to you to make the best decision. So what's essentially happening is we all know that the decision that you're going to make is opportunity cost. All right, so you can either take the 3 to 3.2% 2 or 3 year fix, knowing that interest rates are going up, and hope that after the end of all of the rate increases that all of the variable rates go past that rate and that you'll be better off. All right, so that's what a lot of people are doing, and normal people that are taking fix in this kind of environment are the ones that can't handle any higher increases. So I'll give you an example. They've just had a first child, or they're a little bit later in life and they're slowing down on their job, or they've just changed home and they know their costs are going to go up over the next kind of 1 to 2 years while they fit out the home. Those are the kind of clients that are fixing at the moment, especially when the rates went past 2.8%. Now, when we're looking at the variable rates, I'm telling all of my clients that you've got to have a good idea on where, and have buffers in place, because even though you're taking a 1.99 to a 2.19% at the moment, you have to understand that most likely you're going to have 3, 4, 5, 6 rate increases that are coming through. So at the end of this cycle, if you're doing well, you might end up at 2.8, but if the rates go up more times than what you think, you could end up on like a 3.4, maybe a 3.5. All right, so variable's always a juggle. All right, so from this position, you have to understand that what you're doing is you're making the best decision for you. And if you are going down the variable side of things, you are still ahead. So I'll give you an example. If you take a 1.99% variable rate right now, and rates don't start increasing until, say, June or July, you're already ahead about 0.8 to 1.2%, depending on the lender that we're looking at. And then even if rates start going up in June or July, it still takes over 3 rate increases to get to where the fixed rates are at the moment. So if it takes 6 to 9 months to go up 4 times at 0.25% apiece, you're still ahead 9 months to where the fixed rates were. All right, but at the end of the day, you know where the variable rates are right now. You know they're not going to stay the same. And look, we can only go off commentary that we're getting from the RBA as well as the news at the moment. And we all know that the news focuses on doom and gloom or sunshine. There's no in between. So really, I go directly off what the RBA notes say. And in the last meeting, he did mention that maybe the rates would start going up a little bit sooner than what we expected. So towards the end of this year was what we thought, and maybe that would be coming a little bit sooner, around maybe June or July, but no one has a crystal ball. So hopefully this gives you a good idea on, what interest rates have done in the past, what they're doing right now, and really just trying to tailor something that's suitable for you. Remember, not every borrower is the same. They don't have the same things going on in their life, and really it's all about opportunity cost. And really, you can't be making a decision now and then in 6 to 12 months regretting that decision based on future information. Really, you just need to focus on the information that you've got now. Make sure that you're well informed and you're dealing with a broker that knows what they're doing and understands the market, and make sure that they're giving you the information, and then you make a well-informed decision based on that. Okay, because at the end of the day, that's all we can do. And if you are taking a fix, really, some people say that you're actually betting against the bank, because banks price their fixed loans and normally they get a higher margin out of their fixed loans than they do variable. So they've got all these economists and pricing analysts in the background that are understanding where the bond yields are here and overseas, and really they're pricing those loans in the future to obviously have an economic benefit for their business and their bank. So a lot of the time, if you are taking a fix, you're essentially taking a contrarian view against all those economists and all those. So at the end of the day, a lot of people like taking the variable just because at the end of the day, you can move banks every kind of 2 to 3 years without any break costs, and you're not taking the contrarian view against a lot of the analysts that price the fixed loans for the big banks. So hopefully this video has helped you. If you need an active mortgage broker that is very well informed in this space and helping clients every day, send me an appointment. In the description box below there is an appointment button that you can book an appointment with me. Hit that subscribe button, hit that like button, and leave me a comment if you're enjoying this content. All right, we'll see you on the next video. All right then, bye.